I put over $300,000 into a single crypto project a little over a year ago. It was a part of what I saw as an easy way to make essentially free money. Many at the time said that it was too good to be true. Here's what ended up happening a year later. Back in 2021, there was a really popular project called Olympus DAO. This project was a massive leader in what was called back then the DeFi 2.0 movement. And at one point, Olympus DAO had this crazy APY of over 100,000%. And it was hailed as like essentially the next great thing in crypto, only to eventually come crashing down. And for most, the story of Olympus DAO stops here. For most people, they stopped paying attention to it after all of this happened. However, an insane amount has happened since then that most people are completely unaware of. And it was during this period of time, after the collapse of Olympus and during this development period that most people weren't paying attention, that I ended up sticking $300,000 of my own money into Olympus DAO's OHM token. And that might sound absolutely insane to some of you guys. However, it's not quite exactly what it seems. And at the time that I did it, I viewed it as essentially this infinite money glitch of sorts. At least that's what I thought. But let's start from the beginning and talk about what happened after Olympus fell from popularity. Olympus DAO has always had a very specific vision for what they were building. And despite most people thinking that the project had failed, they actually did exactly what they set out to do at the very start. They had always stated in their white paper that the intention was to start out with a really high APY to attract investors, bootstrap the project, and then lower that APY over time. It was basically a way to incentivize and reward early token holders to bootstrap the project and get it going. It's really not that different of a concept from like an airdrop. This bootstrapping process for Olympus actually ended up being insanely successful, with Olympus today sitting on a massive treasury of over $186 million in stablecoins, representing the fifth largest treasury in all of crypto. And although once the APY was 100,000% for staking on Olympus, today it's actually 0%. Now, with phase one of the project being insanely successful, and that was bootstrapping the project, building this massive treasury, Olympus began rolling out their second phase of the project. And this is where most people, again, stop paying attention. The next phase of Olympus involves stabilizing the OHM token. The goal of OHM has always been to be a decentralized reserve currency of sorts, a truly decentralized currency that's not pegged to any fiat asset, but is actually free floating. It can go up and down in price. But for OHM to be a decent decentralized reserve currency, it would have to be somewhat predictable and stable, something that historically it definitely hadn't been. And to solve this issue, they ended up approaching it from two different angles. First off, they provided deep and thick liquidity for Olympus's OHM token. Second, they launched something called range-bound stability. And range-bound stability is actually genius. They basically created two giant walls of buy pressure and sell pressure around the price of OHM. So for example, when the price of OHM falls below a certain threshold, the protocol uses some of its $180 million in capital to buy OHM, pushing the price back up. And when the price of OHM goes too high, the protocol sells some of that OHM it bought, pushing the price back down, thus achieving a predictable and stable price for OHM. And the game theory behind all this is actually even more insane. As the market learns to trust these ranges, as they see the protocol successfully buying the floor and they see the protocol successfully holding the ceiling, they begin to themselves trust these ranges. And they actually start enforcing these ranges without the protocol having to do anything. For example, when price approaches the bottom of the range, before the protocol starts actually buying, people know the protocol is going to buy OHM and push back up the price. Therefore, they know the price isn't going to go any lower. So they actually front run the protocol and buy OHM first, knowing price can't go any lower and thus will go higher. And when price gets too high, people sell, knowing the protocol won't allow prices to go higher and will sell soon. This means that traders end up providing a ton of support to these ranges, making it so the protocol has to do a lot less work and organically enforcing these buy and sell cushions. Range-bound stability ended up going live in late November 2022. And you can see on a chart that the price of OHM became incredibly stable after this. And one thing that I haven't mentioned yet is that the range for OHM is slowly raised over time, causing the price of OHM to slowly and predictably appreciate over time. At least in theory, that's how it's supposed to work. And when it went live, that's exactly what happened. Between November 2022 and October 2023, the price of OHM went up by 46% slow and steady. And it was around this time that Olympus launched a new mechanism called cooler loans. And cooler loans were absolutely unhinged. You could take your GEOM, which is just staked OHM, and take out a loan against it for up to 95% loan to value ratio. Meaning if you had $100,000 in GEOM, you could take out a loan for $95,000 in DAI. That by itself is already pretty insane. But what's even more insane is on top of this, these loans are liquidation free, meaning you can't get liquidated with these loans. If you don't know, that's the biggest risk for like a DeFi loan is that you end up getting liquidated. For example, say traditionally you go on Aave and you take out a loan for your Bitcoin at 50% loan to value ratio. That means if you have $100,000, you're taking out a loan for $50,000. Well, if the price of Bitcoin crashes low enough, you can actually get liquidated, meaning the protocol is going to automatically sell your Bitcoin to make sure it doesn't have any sort of loss. And this happens all the time. People will try to leverage up with these loans on Aave, etc. The price of Bitcoin will dip lower than they anticipated, and they'll get liquidated, losing all of their Bitcoin. So it was insane to me that cooler loans were liquidation free, meaning I couldn't be liquidated and I could borrow up to 95% of the value of my GEOM. And add on top of this, the annual interest rate for these cooler loans was only 0.5%. This is why at the time, I basically felt like it was an infinite money glitch. I could take a huge amount of capital, buy GEOM, immediately turn around and take out a loan against my GEOM for up to 95% of its value, and have my money working in two different places at once. All with essentially my max risk being 5%, meaning even if GEOM went to literally zero, the most I could lose is 5%. And after really thinking this through, reading through all the documentation, actually going in the Discord and asking a ton of questions, I ended up feeling confident in this strategy. And I took a huge chunk of my capital, invested it into GEOM, and did this cooler loan strategy. And when I say I took a huge chunk of my capital, I took almost $300,000, which is a massive amount of money for me. And I bought GEOM with it and then took out a cooler loan for 95% of that value. And then I took the DAI that I got from that loan and I went and bought ETH as well as various other alts. This enabled me to have my capital working in two different places at the same time. Essentially, this is a form of leverage, but with the insane caveat of I can't get liquidated. And again, this is all what I was thinking at the time. Here's what actually ended up happening after. The price of OHM ended up slowly appreciating over the next few months and then continued going up for all of 2024. Then, in late summer 2024, Olympus yet again launched a new mechanism, implementing their own version of buyback and burns. Olympus's $181 million treasury is held in DAI, and it takes advantage of something called the DAI savings rate. It's basically a form of real yield that comes from US treasuries. Olympus decided to take this yield and use it to buy OHM tokens on the open market, which is a natural way to push up the price of OHM. And they were generating around $83,000 in profit per week to go towards these buyback and burns. Now, Olympus's buyback and burn is actually extra unique because of what comes after they actually buy the OHM token. After the protocol buys the OHM token on the open market, it then deposits it into a cooler loan, taking out a loan against that OHM for 95% of the value, allowing it to unlock the DAI that's held within that OHM. And then it uses that DAI to buy even more OHM on the market and keeps doing this repeatedly. This results in a pretty massive buyback and burn for every $83,000 in profit they generate, and it takes that OHM off the market forever via the cooler loan. If you're not understanding any of this, long story short, this had a huge impact on the price of OHM, heavily pushing the price much, much higher, to where since the date of the launch of RPS back in late November 2022 till today, the price of OHM has gone up over 100%. And that's been a slow and steady, consistent climb over the past 2 years. And personally, I've been able to make over $87,000 via my cooler loan strategy over the past year, which is absolutely insane. And this was an opportunity I shared exclusively in the Obsidian Council, my private community, back when I jumped into it. Other members were able to jump in as well, allowing their money to be put to work in two places at the same time and make a decent profit via OHM going up in value. If you're interested in joining, currently the Obsidian Council is sold out, but you can join the waitlist in the description of this video. And just to pause for a second, I know this can be really confusing and some people seem to have a really hard time grasping the idea of your money being in two places at once. So let me explain that part really simply. If you take $100,000 and buy GEOM and then deposit that into a cooler loan, allowing you to get $95,000 in DAI, you would have $100,000 deposited into GEOM and $95,000 in DAI, which is a stablecoin, for a total of $195,000. Even though you started off with $100,000, now you have $195,000 worth of exposure. And let's say you take that $95,000 in staples and you invest in something like Akash. And let's say Akash ends up going up 3x. Well, now your $95,000 is worth $285,000, which is obviously pretty awesome. And let's say at the same time, your $100,000 in GEOM also ends up tripling, meaning now you have $300,000 worth of GEOM. In order to realize that profit, you would sell $95,000 worth of your Akash from your total of $285,000 worth of Akash and use it to pay back the loan, allowing you to profit $200,000 plus the original $100,000 that you invested. Total between the gains you made from Akash and the gains you made from GEOM, you'd have $490,000. And you would have gotten that profit by having your money in two different places at once. Versus, let's say you didn't do the cooler loan and you just took that $100,000 and invested it straight into Akash instead. Akash ends up tripling the same way, and your $100,000 ends up turning into $300,000. Still awesome, obviously, but you ended up making $190,000 less using this strategy. Obviously, that's still a little bit complicated, and maybe that is still hard to understand, but hopefully that helps you better understand how this strategy ends up working. Anyways, year one of this strategy has been obviously a massive success. I'm gonna keep doing this strategy for another year and see how it ends up playing out. Cooler loans are still available if you wanna check them out. Obviously, it's not for the faint of heart, and you should take the time to understand how these things work before just jumping in. So far, the RBS experiment has been incredibly effective, and I think Olympus is underrated for what they've built. I think as more time passes and more people begin to trust this stability, we could see a really interesting ecosystem and some really interesting apps and products built around Geom. And if that ends up happening, that should hopefully push the price of Ohm up further. Either way, this has been a really fun experiment and shows the value of making sure you're paying attention during the bear market, actually learning how these things work and taking advantage of opportunities as they come. As always though, again, none of this is guaranteed. Crypto is extremely risky. You can always lose money investing, and none of this is investment advice. Make sure to sign up for my free weekly crypto newsletter. It's mostly just all the content I put out each week in an easy email so you don't miss it. But occasionally I drop some other cool stuff in there, including I've dropped a few projects early in the newsletter that ended up doing insanely well. Also, if you really want to dive deep, make sure to check out my weekly podcast, the 1 to 1 Million podcast. I interview projects, talk about the markets, and interview various traders and experts in the crypto space. As always, if this video is helpful, make sure to hit that like button. If you have any questions or comments, or maybe any other projects that you think I should be taking a look at, let me know in the comments down below. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.